Hi, this is Jim Platt of Fredrikson and Byron. I want to welcome all of you to our webinar today. The webinar is on fair market value valuations in healthcare transactions and how they can be used against you. I'm here with my partner, Steve Beck, and we will be going over our slides and giving you our comments and insights into the topic. If you have questions during the webinar, you should find a chat box down at the bottom of your screen on the right, where you can type in your questions, and we will do our best to answer those toward the end of the webinar. And if we're unable to answer your question, we can get back to you by email. If you don't see the chat box appearing down there, click on the box at the top of the screen on the right that says chat, and a chat box should appear. One other housekeeping matter, I want to let you know that our next webinar in December will be on December 12th at 12 o'clock Central Time, and we will be talking about the developments in the physician fee schedule and what's coming up next year with regard to that. So, going now to our topic today on fair market valuations and healthcare transactions and how they can be used against you. I wanted to just start off talking a bit about the laws that require fair market value and the various definitions and comments that the regulatory agencies have made about fair market value. I'll then walk through some case law examples to give you a flavor of how valuations and fair market value can come into play. Next, we'll have Steve talk about how appraisals and their assumptions interrelate and how appraisals are sensitive to those assumptions, how poorly constructed valuations may hurt more than help, and factors to consider outside of survey data. And after Steve's done talking, we'll go to questions and answers. So first of all, with regard to the laws that relate to fair market value, there are really three that are key and a fourth that can come into play. The Stark Law is an important law that has many fair market value components to it, which I'll get to in a minute. Medicare anti-kickback law also has fair market value in many of its safe harbor requirements. The federal tax laws for tax-exempt 501c3 or 501c4 organizations have fair market value components to them. And the False Claims Act doubles back and layers on top of Stark and Medicare anti-kickback, because if there's a violation of the Medicare anti-kickback law, that may form the basis of a false claim lawsuit. So there's at least, and you may also have laws under your particular state that raise fair market value issues. Let's start off by considering the Stark Law. The Stark Law, as many of you know, prohibits an entity from billing Medicare or Medicaid for designated health services referred by a physician that has a financial relationship with the entity unless an exception applies. Designated health services include things like imaging, includes hospital services, includes laboratory services, and a host of other services listed in the Stark regulations. So a common scenario would be that the entity, being the hospital, cannot bill Medicare or Medicaid for hospital services referred by a physician who has a financial relationship with the hospital unless an exception applies. And of course, that happens all the time. It happens in at least two situations. Physicians in physician-owned practices stand in the shoes of the financial relationships that their practices have with hospitals, imaging centers, and other entities that are going to bill Medicare for those services. And that necessitates an exception under Stark. So anytime you have a hospital or an imaging center or another entity that's billing Medicaid health services and it has a financial connection with a physician-owned practice, you'll need an exception under Stark to qualify those referrals under the Stark Law and for the hospital to be able to bill those services. And as we'll see in a second, those exceptions require fair market value. The other very common scenario under Stark is that the hospital has a financial interest directly with the physician. Not the physician group where the docs stand in the shoes of the group, but with the doctor directly. So situations here, physicians are employees of the hospital or medical directors of the hospital. In those situations, the doctor has a direct financial relationship with the hospital, necessitating an exception under Stark. Those exceptions under Stark are numerous. They include exceptions for rental of office space, for equipment leases, bona fide employment, personal service arrangements, isolated transactions, and a fair market value compensation exception. So, for example, if a group of doctors is renting office space from a hospital, there's an exception under Stark that's available to cover that financial relationship, but that exception requires, among other things, that the amount paid be consistent with fair market value. So if you have a group of doctors that's in a lease situation with a hospital or an imaging center or another entity that's providing designated health services, you need to be sure that your office lease complies with that exception, including fair market value. Likewise, equipment leases. Let's say that there's a joint venture involving an imaging center, and there's a lease involved where the doctors have a financial interest in that lease. That lease for the imaging center equipment needs to be consistent with fair market value. Bona fide employment is a big one. The hospital employs the doctors. The doctors are employees of the hospital and receive compensation. The compensation to fit within that Stark exception needs to be consistent with fair market value. Personal service arrangements, independent contractor situations, leases of technicians, leases of staff, those too have exceptions, but again, consistent with fair market value. Isolated transactions, sale of a practice, fair market value. So in each of these exceptions under Stark, you can hear that there are exceptions, but each of these exceptions requires fair market value. Now, the Stark definition of fair market value is multifaceted. It means the value in an arm's length transaction consistent with general market value. General market value then means the price that an asset would bring as a result of bona fide bargaining between well-informed buyers and sellers who are not otherwise in a position to generate business for the other. And I'll pause there just to comment on a common theme. Healthcare is different than other industries in that we can pay for referrals. We pay other to generate services. The bona fide bargaining is important, but the bona fide bargaining has to be between informed buyers without regard to the value of the referrals that they could send back and forth. Then Stark goes on to comment that usually the fair market value is the price at which bona fide sales have been consummated for assets of like type, quality, and quantity in a particular market at the time of the acquisition, or in the case of compensation, compensation included in bona fide service agreements with comparable terms at the time of the agreement. Few things to note there. Note that we're looking at comparables of a like type, quality, and quantity. That's referring to what sort of other organizations have done similar deals, and we're referring to the market. What's the particular market? Are we in a rural setting, an urban setting? And we're also looking at the time of the agreement, not years before the deal or years after the deal, but at the time of the agreement. Those are some of the key aspects of the Stark fair market value definition. Stark also has some additional comments with regard to leases of equipment and office space. With regard to office space, fair market value means the value of rental property for general commercial purposes. The value may not be adjusted to reflect the additional value that the lessee or lessor would attribute to the proximity or convenience when there's a source of patient referrals there. So if you're looking at a medical office building adjacent to the hospital, a situation where the parties are close together, the value of that has to be looked at from the perspective of general commercial purposes and not adding a premium or making an adjustment to reflect the referrals and the proximity and convenience to those referrals. A rental payment, according to the comments by the Stark folks, does not take into account intended use if it takes into account the costs incurred by the lessor in developing or upgrading the property or maintaining the property or its improvements. So it's certainly okay to take a look at that's not going to be a concern. It won't take into account the proximity or intended use if we're looking at that. CMS also commented in the Stark preambles that changes to the lease terms that are material to the rent, for example, changing the amount of the space leased, may cause the rental charges to fall outside of fair market value. And they give an example in their comments of a lease situation where a number of square feet is originally leased at this rate, and then down the road they added additional square footage to the rent, but they didn't make an adjustment in the rental amount. An example of where now we've had material change in the lease, we've increased the space, but we haven't changed the amount of the rent. So that's a fairly straightforward example from CMS in their comments, saying that you could have changes down the road that may cause it to fall outside what you originally set as fair market value in a space lease situation. CMS also notes in comments to the Stark regulations that with regard to tenant improvements, whether those tenant improvements can be amortized over the term of the lease versus their useful life depends on the ability of the lessor to lease the space with the improvements to another tenant. For example, if you've got a group of doctors and you're going to build out the space for the doctors and you're going to put in a lot of fancy improvements, the question is, should we amortize those improvements over their long useful life or over the remaining, say, 5-year term or 10-year term of the lease? That turns, according to CMS, on whether those tenant improvements could be easily used by another tenant or if they were specifically customized to that particular physician group, in which case they should be recouped over a shorter term. CMS also makes the following comments. Again, these are coming out of the preambles to the Stark regulations. They note that a wide range of methods may be acceptable to determine fair market value. A particularly helpful comment. IRS has said the same thing, that fair market value isn't necessarily one number, but a range of numbers, and that a wide range of methods may be acceptable. The methods must be commercially reasonable and provide evidence of how compensation is comparable with what is ordinarily paid for the item or service by the parties in arm's length transactions in that area. Again, arm's length, looking at the area, comparable deals. And with regard to leases, a list of comparable leases for office space and independent appraisals may provide evidence of fair market value. So certainly comparables, if you're looking at office leases, comparables are important, and independent appraisals of what similar rent has been in other settings in that market may provide that fair market value evidence. And cost plus a reasonable rate of return may also be an acceptable methodology according to CMS, again depending on the circumstances. CMS also makes mention that reference to multiple objective, independently published salary surveys remains a prudent practice for evaluating fair market value. So when you're in, I'm moving now from not office and equipment leases, I'm now in the area of physician employment agreements, professional service agreements, medical director agreements, on-call agreements, situations where we're providing compensation to physicians. And these situations, CMS feels that looking at independently published salary surveys remains a prudent practice for looking at fair market value. But although it's a prudent practice, CMS goes on to say that although good faith reliance on an independent value, such as an appraisal, may be relevant to the party's intent, it does not establish the ultimate issue of the accuracy of the valuation figure itself. And as I'll talk about when I get to some case law examples, the fact that you've got a valuation or an independent valuation does not necessarily save you if the valuation is faulty or is based on aggressive assumptions. So CMS concludes that ultimately the appropriate method for determining fair market value will depend on the nature of the transaction, its location, and other factors. And they don't tell us what those other factors are, but they say that there could be other things involved, so that having that independent appraisal is not in and of itself necessarily going to give you the green light. Now that's Stark. So now under Medicare anti-kickback, Medicare anti-kickback is an intent-driven statute that prohibits the payment of remuneration in exchange for referrals paid for under Medicare, Medicaid, federal health care programs. Unlike Stark, it requires intent, and under current court guidelines and OIG guidelines if one purpose of a deal is to pay for referrals and the Medicare law is violated. And unlike Stark, which has civil penalties, Medicare has criminal penalties. So Medicare anti-kickback laws have an additional element risk in that it's a criminal statute as well as civil. Medicare anti-kickback laws, here the OIG has commented that if a health care provider gives or receives something of value that is not at fair market value, an inference may be made that the exchange was intended to induce or reward referrals. So this is why fair market value is important with regard to anti-kickback, in that if something is not fair market value, then it raises the question whether something extra was being paid to get the referrals. And here the government comments that by fair market value we mean value for general commercial purposes. However, fair market value must reflect arm's length, and it has not been adjusted to reflect additional value attributable to the referrals of business. The Medicare anti-kickback statute has a variety of safe harbors. If you fall within the safe harbor, your arrangement is exempt from the reach of the anti-kickback law. Those safe harbors protect things like space and equipment leases, personal service contracts, but require that the aggregate payment be set in advance, consistent with fair market value, and not be determined in a manner that takes into account the volume or value of referrals. And I want to just pause here and point out to you that although Steve and I are talking a lot about fair market value is interwoven here with these additional elements, the set in advance requirement and the requirement that the amount not be determined in a manner that takes into account the volume or value of referrals. And lastly, although we are not talking about it today, there's also a requirement interwoven in these safe harbors and Stark as well, that things be commercially reasonable. And commercial reasonableness is separate from fair market value. Just because something's fair market value, there may be other terms that are not commercially reasonable. So it's important to understand that we're talking today about fair market value, but there's other aspects to this that you also want to keep in mind. The OIG guidance for hospitals that they issued a bunch of years ago also notes that the Office of Inspector General, if they're reviewing a situation, will ask whether the fair market value was based on a reasonable methodology, whether it was uniformly applied and documented. And if comparables are used, the hospital should be cautious of using ones where all the providers of the services are physicians. The OIG, as we know, will not give advisory opinions about whether remuneration is consistent with fair market value. You just won't get that from them, but they've got a variety of different opinions that they've issued over the years that reflect on fair market value. Things like the opinion in 99-2, where they talk about discounts and how discounts below cost and discounts less than the amount provided to others with the same volume but who don't make referrals are suspect. So anytime you're providing discounts or anytime you're charging something below cost, it's a flashing red light as far as the OIG is concerned about why that came to pass. They've also commented that per patient, per click, per order fees are suspect because they're concerned that they're going to be a payment mechanism that will reflect the value or volume of referrals. And lost opportunity payments in Advisory 0905 that don't reflect real lost income, payment arrangements, no identifiable services are provided, high on-call payments relative to the doc's regular practice income, and double dipping for covering the ER, but you're also paying the doctor for their work that they generate in the ER. That also may raise fair market value anti-kickback issues. Now, lastly, the final law to talk about here is the Internal Revenue Code. A little different set of requirements here. Here we're looking at the 501c3, the tax-exempt organization. So we're looking here at the hospital or the health system, and we're asking whether the hospital or the health system has made payments in excess of fair market value. In extreme cases, the hospital can take away the tax-exempt status of the hospital or health system, so revoke its exempt status, which would be a disaster in that the tax-exempt bonds of the health system are going to become taxable bonds. it's going to result in all kinds of problems. And that has happened. The IRS also has at its option the ability to apply tax penalties, intermediate sanction penalties that apply to excess benefit transactions where the hospital has provided a benefit to a disqualified person like a doctor or a CEO, and that value exceeded the value of what was received. So excess compensation to the CEO or to doctors who are in a insider type situation with the exempt entity, those intermediate sanction penalties can apply. Then the IRS sets out in the regulations how an exempt organization like a hospital can establish a presumption that the payments made are reasonable. This is called a rebuttable presumption. And most tax-exempt hospitals follow this process. What they do is that they have the compensation arrangement reviewed by an independent members of the board of directors. They look at objective third-party evidence, such as salary surveys or information about what other organizations are paying in the area, showing that the payment's consistent with fair market value for the services that are being provided. Those results are reviewed, as I said, by the outside members of the board, and the decision is well documented. If you follow the guidance and the regulations, then you, the taxpayer, the hospital, have a presumption that the compensation arrangement is reasonable, and now the burden shifts to the IRS to show that it's unreasonable. And that's an important thing to try to accomplish. The IRS also has a variety of rulings talking about physician office spaces, equipment leases, and hospitals purchasing physician practices. They have a bunch of guidance out there talking about how these need to be consistent with fair market value. Steve will be talking a little bit more about IRS guidance in terms of purchasing physician practices and the different methodologies that they talk about. Next, I wanted to just give you a snapshot of some of the case law out there talking about fair market value and how appraisals were involved in these situations, sometimes to the benefit and sometimes to the detriment of the parties. And there are a lot more cases out there than these. These just happen to be some that I thought were particularly illustrative of these issues. The first one is Goodstein versus McLaren. This is a decision actually that the government lost. This was a situation involving an orthopedic group in Flint, Michigan. They had a building that they owned. It was in a building partnership, an LLC, and they entered into a lease with the hospital for the hospital to lease space from the doctors. And the question was whether the rent under that lease was in excess of fair market value. It was a qui tam case. It was a false claim case brought by an individual, and then the government intervened as they can in these false claim cases. And the government asserted that the rent being paid was in excess of fair market value, and the defendant doctors said, no, it's consistent with fair market value. And it became, as these cases can become, a battle of the experts. So the government brought in its expert who said that we think that the rent being paid here was in excess of fair market value. And then the defendant doctors brought in their experts who said, we think the rent is consistent with fair market value. So the thing about, and the government lost this case, and the reason why the government lost this case was that the judge felt that the expert that the government used was not looking properly at the right comparables in the market, wasn't looking at comparable buildings, was looking at gross rent and never considered net rent or a triple net lease. So the government expert really did not do a very thorough job in the view of the judge to come up with the right kind of comparables, whereas the defendant's experts looked at both gross and triple net lease amounts, and the government was persuaded that those experts did a better job at trying to come up with fair market value. The other thing that was interesting in this case is that the judge spent a lot of time going over how the negotiations were arm's length. And later cases will show you that arm's length negotiations by itself won't save you, but they certainly help. So in this case, there was lots of evidence of the negotiation between the hospitals and the doctors over the terms of the lease. This was not a situation where the hospital said, you know, whatever you want, we're trying to, you know, keep you in town or whatever it is, you know, what can we make work here? That wasn't the case here. They negotiated for a long time, and the hospital didn't get everything what they wanted. The doctors didn't get everything they wanted. So that arm's length negotiation, coupled with a good outside expert that the defendants used, carried the day, and the defendants won that case. But the thing that you need to understand about this is that this fair market value question becomes, in this case, points it out, kind of a battle of the experts. You know, if the government believes that your payments are in excess of fair market value, they're going to bring in their experts to take their position, and you're going to need your experts to take up your position. And so that's the thing that concerns me about these cases, that it would be better to be doing your fair market value review at the time you did the deal rather than to have to try to come up with the evidence later once the government's investigating it. The LAC facilities case, this is an old IRS revocation case from the 1980s, but what we had going on here was that the IRS revoked the 501c3 exemption of an organization after it did an audit. And what happened here was that this LAC facilities organization, a hospital, had purchased 7 physician practices in the late 80s for $17.4 million. And it turned around and entered into PSAs with the doctors. But one of these practices only had tangible assets of $170,000, and it was purchased for $6.8 million. So there was an enormous gap between tangible assets and the $6.8 million that was paid. In addition to that, this LAC Facilities Hospital that purchased these practices then turned around and sold them later back to physician owners. And they sold those back to the physician owners and ended up writing down the note to $273,000. So you had a situation where you had insiders involved in this, which is going to even heighten questions more. And the valuations that were used here had flaws in them, according to the IRS. There were flawed capitalization rates, and they had flawed treatment of expenses. Instead of treating expenses as operating expenses, which the IRS felt they should have been, the appraisal treated those as discretionary. And the appraisal also had an inconsistent treatment of physician compensation. So the IRS took issue with the assumptions that were in that appraisal. The other thing that really hurt the defendants in this case was that the board minutes revealed really sort of the true intent, and here a desire to overpay to get the business. So that particularly was another factor that caused the IRS to yank the exemption of the organization. Another IRS case, here we had a situation where the board of this psychiatric hospital sold the hospital to a corporation owned by some of the board members. And they actually had an opinion from the IRS, a private letter ruling, that said so long as it's fair market value, it's not going to hurt the exemption of the psychiatric hospital. Well, of course, so long as fair market value was the condition in that opinion, and it was later determined post-closing that fair market value wasn't the situation. And here the problem, one of the problems was that the appraisal that they had was several years removed from the closing. And in the intervening period of time, there were changes in the market. There was a certificate of need process that went into play that increased the number of beds at the hospital, and other factors were going on. So they had an appraisal in 1981, the sale occurred in 1983, and they had material intervening events that weren't taken into account. So what this tells us is that if you have a valuation, you know, it needs to be timely, not years before the deal occurs, and to think about whether there have been material events since the valuation that may cause it to have become stale. And this also tells us arm's length negotiations here were not enough to save that situation from loss of its exemption. Another tax court case, this one was interesting because they had an opinion from a large valuation firm. This was in the state of Mississippi. The large valuation firm gave an opinion about what they thought was the market value, but the IRS said that valuation was unrealistic because it didn't consider or take into account that there was a moratorium on home health care licenses in the state, that the home health agency had a large market share, didn't really look at comparable sales, and had been providing generous employee bonuses. This was a situation where the insiders sold it to themselves at less than fair market value. So, they were trying to come up with a low value, but the appraisal didn't look at the fact that it should have been higher because there was a moratorium. That would have made the business more valuable, had a big market share, didn't look at that, didn't look at comparable sales, didn't look at the fact that the business had been throwing off generous bonuses, so it must be a pretty successful business. So even though the valuation came from a large and well-recognized firm, that wasn't enough to save it because it had flaws in that it didn't look beyond the immediate circumstance to kind of the environment in which that business was operating. Covenant Medical Center is one not too distant from here down in Waterloo, where a disgruntled physician brought a claim against the hospital that they had paid in excess of fair market value to their 5 physician specialists. That resulted in a $4.5 million settlement. That case illustrates to me that you can have a fair market value problem, not because the IRS is knocking on your door or because the OIG is knocking on your door, but because a competitor sees it or somebody else in the organization sees it and raises a question about whether it's fair market value. The next case, and I think one that's particularly significant and recent, is the Bradford Medical Center case. And this one really illustrates how difficult it is to deal with covenants not to compete. What we had here was a group of doctors that had a nuclear camera in their practice. And they decided that they would lease their nuclear camera to the hospital. The hospital would pay them for the lease, and they would also agree for 5 years not to compete with the hospital. So the hospital asked its accountant, asked a valuation consultant to advise them about whether the amount the hospital was going to pay for the non-compete plus the lease was consistent with fair market value. And so what the valuation consultant did was the valuation consultant said, well, how much are the doctors referring today to their business? So let's figure out what that is. Now they're going to have a non-compete, so they're not going to be able to refer to their own nuclear camera business. So how much will they be referring to the hospital? Well, I'm going to assume that all of the business they're referring to themselves today would be referred to the hospital. So I'll figure out the value of the non-compete by taking a look at what's being referred now and what I think is going to be referred after, and we'll figure that out as part of the valuation. So when this came to light, it became pretty apparent that fair market value was being determined based on anticipated referrals. Remember that I said that under the law, it's fair market value, and in addition, fair market value cannot be determined in a way that's based on the volume or value of referrals. And because they were looking at referrals and talking about what was going to happen with referrals, the fair market value was being determined based on anticipated referrals. Therefore, it violated the law, and therefore it was in excess of fair market value. The other thing that was particularly bad in this case was that there were statements in this case made by hospital executives and others that they were in fact anticipating that this business would come the hospital's way, and that was one of the reasons why they were doing this non-compete in the first place. They also contemplated that the nuclear camera would move from the doctor's office to the hospital. It never moved. So things happened in that case that weren't lined up with what was supposed to happen in the case. But the thing that particularly hurt the case was the discussion in the valuation of the non-compete about how we should look at referrals and figure out, where those referrals would go if there's a covenant not to compete. So I'm going to turn this over now to Steve, and then after Steve, we'll go over what your questions may be.
Thanks, Jim. So I want to talk about a special case of this fair market value issue, and that is the purchase of a business in the healthcare industry. And what has grown up over the last 20 years or so is a pattern or practice in which hospitals often buy medical practices, and very frequently they get an appraisal of the medical practice to sort of help them support the practice internally and externally. I think that this is a very interesting and complicated topic. It's more complicated than we can deal with in 15 or 20 minutes. So I'm going to do some things that hit the high points, but hopefully will bring us back to this notion of fair market value that Jim was talking about, because I think that that's a key. So I would start in any kind of business acquisition scenario in the healthcare industry with the question, do we want to have an appraisal? And it's really a threshold question. And there are a couple of reasons. There's probably a million more, but I'm going to say there are a couple of reasons why somebody might want to have an appraisal. One, because we don't have any idea what this thing that we're trying to buy or what we're trying to sell is worth. And we'd like somebody to help us try to figure that out. Just as a matter of how the deal goes together, the parties have to get themselves comfortable with what the price is or what the range of appropriate prices might be. So there's a huge part of this practice that has nothing at all to do with what we're talking about as lawyers all the time. It really has to do with the business that's going on between the two parties. What is it that the transaction ought to be priced at? Second reason to have an appraisal is to try to help ensure that we are complying with the laws when we do the transaction. And Jim just went through some of the many ways that an acquisition of a practice might violate the law if it is not in accord with fair market value. Interesting to point out, and I think it comes out in some of Jim's kind of specific slides, there isn't a fair market value exception that says if you have an appraisal, you're okay. The appraisal is part of the way you try to deal with these complicated interlocking sets of laws. And as Jim said, under the Stark law, fair market value is an explicit element. Under the anti-kickback law, you may violate the law even if you are paying fair market value. Under the tax laws, there are all kinds of complicated and slightly different questions about whether an insider is getting unfairly paid by a tax-exempt organization. The governmental authorities have provided really very little in the way of guidance, governmental guidance, about what you would do to support fair market value in a complicated transaction. Probably the best, maybe the first and best, it's really kind of old now, source for this is the CPE, the Continuing Professional Education text that was published from the IRS. It was an article in 1996. Kaiser and Henshu spent a lot of time and really sort of set out how practice appraisals are done. And it's a very interesting article. I think it would be great bedtime reading for everybody who's interested in this. It starts out with a summary of what the IRS thought in 1996 was why hospitals purchase medical practices. And they said, well, there are lots of reasons why hospitals purchase medical practices. They're trying to provide service to the community in accordance with their charitable purposes. And they're trying to obtain the direct and indirect revenues that are produced by the practices that they are acquiring. And the article goes on to say, in effect, there's a difference between direct and indirect revenues. Indirect revenues are those that come from referrals, and that's the problem. So if someone is trying to justify from a tax perspective the price that he's paying for a medical practice, the price should be based on the value of direct revenues, that is to say what the practice itself earns, not indirect revenues, meaning not the value of referrals. This article and the story that comes out of this article is useful because it fits with all the regulatory schemes. All the regulatory schemes are really worried about whether indirect revenues are being focused on in determining the value of the acquired business. I think it's worth saying that the story that was told in the 1996 article may no longer fit very well with why hospitals purchase medical practices. Nowadays, I hear a lot of hospitals saying that the future is in developing a well-deployed, non-central, outpatient-based network of service providers away from the healthcare campus. They're not trying to focus their energies on supporting inpatient cases. What they're really trying to do is take healthcare out to the people. And one can imagine a purpose for the transaction that's very different than the 1996 story. A hospital wants to buy a practice to be an integral part of an outpatient center that it's developing someplace else. Ultimately, with respect to all these laws, the business justification, the story that you're telling, is key to how the appraisal works. If the risk that someone is going to assert that this is a play to obtain inpatient referrals isn't a very high risk because of the facts in the deal, then you might use the appraisal differently, or you might use a different method, or you might give it a different weight in what you're doing. All of it is designed ultimately to go back to the regulatory questions. What is it that we're trying to show? So I'm going to concentrate not on the reason to have an appraisal, which is because we want to figure out what the deal is worth, and focus, of course, on how it helps us to ensure compliance with the laws. But I think it's worth sort of setting the stage in that way. There is a second question that is kind of a threshold question when you're approaching a deal like this, and that is, do you want an appraiser's opinion or not? And I think this is another sort of key thing. An appraiser's opinion, an appraiser has got lots of information and may be able to provide different levels of precision and certainty in what he delivers to you in the deal. Having the appraiser's opinion is relevant to your defense of the deal, that it's compliant and in fair market value, and certainly relevant to the question, did you intend to do something other than pay for direct value? Were you intending to pay for indirect value? Well, if you say, I'm relying on the opinion of my appraiser, there is a value in that defense. Now, as Jim said, if you rely on the appraiser's opinion and the government says, well, we don't like that opinion, we approach this differently and think you made a bunch of mistakes, then your reliance isn't going to be a trump card that wins this for you. So it's relevant to whether you had a bad intent. It isn't necessarily going to immunize you from possible liability if the government takes exception to the transaction. If you have an opinion, that may also affect how your negotiations go, and that might be something that you like, it might be something that you don't like. Fairly frequently what you see is an appraisal report that comes out, either a final report or a preliminary report, that's followed by a letter from the seller's attorney. And the seller's attorney says, I've looked at the appraisal report and I think it's too low. The seller would like it to be higher. And the buyer says, well, thank you for your letter. We'll talk to the appraiser about it. And the seller typically, or the buyer typically, will then not try to respond and argue about what the seller's complaining about, but take sort of inside what the complaints are, and also work with the appraiser on whether the appraisal works. If you're a regulator, the appraisal report, the preliminary appraisal report, the letter from the seller's lawyer, any emails between the parties or any internal emails about the appraisal, any response by the buyer about the validity of the appraisal or the validity of the assumptions of the appraisal, all of those things would be useful and interesting to the regulator. So one thing that's probably worth doing is being cognizant of what the process is for creating this valuation and what trail of breadcrumbs there is as to whether assumptions were changed, whether things were considered that the IRS wouldn't like. Also worth pointing out that any of these authorities might bring their own appraisal, and that's an old method that the IRS has used. But you can certainly see CMS doing the same thing, or an independent regulator or attacker doing the same thing, where they say, well, we've looked at your appraisal, we don't think it's any good, we've got our own appraisal. All that stuff will go into the evaluation of the validity of the appraisal. So if you look at the IRS article, it talks about the use of multiple approaches to determining the value of a physician practice. And I think these are approaches that would be found out in articles that are in the private industry and in other publications as well. And people talk about these three approaches pretty frequently: the income approach, the cost approach, and the market comparison approach. The income approach is the one that often takes up a huge part of an appraisal report, and it's a discounted future cash flow. What you often see is that the practice income and expense is modeled and projected out for a period of time into the future. And you might see a 5-year spreadsheet that shows income and expense with built-in growth assumptions on both the income and expense side. At the end of the 5-year period, there's a multiplier. And people do the math on this somewhat differently in different appraisals that you see, but the multiplier essentially takes the last year that's specifically modeled and rolls it forward using a factor that's calculated from a discount factor, from a cost of money. Typically that multiplier will result in a residual value that will be something like half or more than half of the total value that's reflected in the appraisal. So the assumption in the income approach is that what we're figuring out is what available cash flow there is for distribution. That is something like some version of margin or profit for the owner of the practice that can be rolled forward and used to calculate a value of the assets that produce that value. Cost approach is another approach that we didn't used to see a lot, but we're seeing more and more. And what it says is, instead of looking at the discounted future cash flow, we're going to say, what would it cost to create a clinic just like the one that we were thinking of buying? And there are all kinds of elements of the practice that you're thinking of buying that might be replaced or might be mimicked, might be put together without buying this practice, but there would be a cost to putting together each piece. So, for example, if you were thinking of buying a 25-doctor clinic, you could figure out what is the cost of recruiting and employing 25 doctors. You could say, well, what's the cost of recruiting and employing all the non-physician staff that go into making up that clinic? What is the cost of obtaining the plant and equipment? What is the cost of other items that make up the ongoing business, the charts? And I've seen folks put together cost approaches that say, well, we've determined the price of the physician workforce to be X dollars per doctor, or a percentage of 1 year's doctor compensation. Same with staff. Here's the interview time, the cost of recruitment fees, and the costs that are related to staffing up with non-physician staff. And then they might say charts. We would have at least a replacement cost of the charts that's X dollars per chart. And the cost approach sometimes, if a clinic has got a a significant number of people can create another large number. Sometimes it's going to be similar to what comes out of the income approach, and sometimes it's not. Third approach that you see sometimes in the report, and often this is the last one that's in the report, and it's used almost as a check on the other methods, is to say what comparable transactions are there in the marketplace. And what I frequently see is, frankly, a report that includes the three, at least two methods, income and market, and then no one looks at the market approach very much. And the reason is that the transactions are very unique, and it's very hard to evaluate whether they fit. Sometimes the market approach includes some mathematical ratios that try to derive a market formula for the price of the practice. I often see that not given very much credit. The part of most appraisals that gets the most interest and perhaps is focused on the most is the discounted future cash flow portion, the income approach. And that really is used to try to get at the ongoing business value, the intangible value of the clinic. And as I said before, the basic idea of the income stream appraisal is that there's some debt-free cash flow that's available for distribution that comes from the practice. There is a great sensitivity to assumptions in the discounted future cash flow appraisal. And a lot of things to talk about as those things get put together. First, often these transactions include a salary guarantee or the provision of other expenses after the acquisition is done. The guarantees typically are short-term. That means that they probably reduce the first few years' return. If you put that into the model that you've put together, that spreadsheet that says here's how we do in year 1, here's how we do in year 2, here's how we do in year 5, it probably winds up reducing the return to the new owner in the first few years. That means that the guarantee essentially simply moves dollars from the appraisal of the value of the practice to the pockets of the doctors who are obtaining the salary guarantee. It probably means that the guarantee doesn't give you anything extra. If the guarantee comes on top of the appraisal and the appraisal assumes no guarantee, then there's a built-in problem with the appraisal and you may have a difficulty if somebody looks at it later. Same thing if you have a clinic that has a huge amount of sort of built-in deferred maintenance. And what is happening is that an appraisal is being done, establishes a value. That value winds up being the purchase price, but the clinic also requires the hospital to invest $10 million in the deferred maintenance, or maybe in a computer system. Those things arguably ought to reduce the net available cash flow that comes out in the first few years. If they don't, there might be a problem with the assumptions that are building up the cash flow model. Second and third big assumptions, and I'm going to show you a little chart on this in a sec, are the discount factor that's assumed and the growth rate that's assumed. The discount factor is typically constructed by the appraiser out of all kinds of rather arcane matters. A resulting concept is a weighted average cost of capital. That means to what extent what would it cost you to use your typical mix of debt and equity capital to run this kind of business. After applying this WACC, the multiplier and the discount factor for the income stream is set out. Another factor is the growth rate. Is the practice going to grow? Is revenue going to grow at 1%, 2%, 3%? Are expenses going to grow at a similar level? If you look at a typical appraisal, and I'm going to skip forward a couple of slides here. This comes from an appraisal report that I got in a real transaction, and it shows the sensitivity of the appraisal, the income stream appraisal, to different assumptions on the WACC and on the growth rate. So if the WACC is 10%, that is a rather low cost of capital, and the growth rate is 5%, really high growth, this clinic would be worth $88 million. If the WACC is 16% and the growth rate 1%, this clinic would be worth $20 million. You put a chart like this together and you pick something in the middle. So the actual price that was determined by the appraiser is one of those middle boxes. But you can see that relatively small changes in these financial assumptions can make a really significant difference in what the ultimate result is in the appraisal. Bottom line, all of the parties looking at the appraisal might be interested in seeing the range of appropriate values that might be part of the negotiation, not necessarily getting an opinion on a particular value. Now, if you're the appraiser really needs to, if he's giving an opinion, pick one of these numbers. Say, we believe the WACC is 13, and we believe the growth rate is 3. So 40 million is the number. And it's really not fair to say to the appraiser, you know, you picked that 13 and that 3, but we would really like it to be 11 and 2. So we'd like a $49 million value. And if that winds up being what the relationship among the parties is afterwards, and somebody looks at it, because this is all discoverable information, it'll look like the appraisal was a fake. So kind of carefully moving into these assumptions, understanding them all in the beginning as you go forward, and making sure that revenue and expense is properly reflected in that valuation is pretty important. Next. There's a potential problem in these appraisals if value is ascribed to referrals. An example I want to give is pretty easy to see. It's somebody that's using this appraisal method to address a different kind of transaction. So instead of hospital acquiring a practice where we say, well, we want to look at the value of direct revenues but exclude indirect revenues, they said, well, instead hospital and clinic are each going to contribute their imaging businesses to a joint venture, and the hospital wants to get credit for contributing the value of its business stream, of the stream of work that is currently inside the hospital. And in this example, and it comes from a real situation, the hospital said, appraiser, go tell us what the value of that imaging work that we currently do is, so we can get credit for it when we contribute it to the joint venture. And the question is then, are we creating an appraisal of the value of direct revenue, or are we creating an appraisal of the value of revenues that we're going to obtain by influencing the referral of patients to our new joint venture instead of to our hospital? Really, the same thing could be said about somebody doing this on the other side. If the clinic says, hey, we're contributing most of the patients, we should get a benefit when we determine our capital contributions, this is going to be detrimental, not helpful, when we use this kind of a method. So very frequently we see some thing in the appraisal report that talks about the use of other methods to check the value. The IRS article directs us to allocate values to specific assets. And they say, look at it this way. For the tangible assets, it's probably better to use methods other than the income method. For medical and office building equipment, furniture, fixtures, and equipment, use a cost method. For buildings and real estate, use a market method. For intangibles, it's more likely that you would want to use an income method. For covenants not to compete, contracts, trade names, leases, other things like that. For the force in place, they recommend a cost method. Now, I think that it's really valuable to use this allocation just because you get a sense of what the risk is in your overall transaction. So in one deal that we looked at, the appraisal came back, an income stream appraisal, and showed a value of about $45 million. A market appraisal of the real estate involved came back showing $42 million. If we were doing an allocation, we'd say, well, we're really only talking about $3 million that's being allocated to intangible assets. This seems like a transaction that has an extraordinarily low compliance risk. And the question really now in the use of this appraisal is, how shall we use it to determine what's the right price for the parties to pay? Because we're not that worried about this from a compliance perspective. On the other hand, and Jim had this example, if we have an income stream appraisal that shows a very high value and there's almost no tangible value on the balance sheet or in the transaction, we might say, well, the income stream appraisal is our only bulwark against a potential compliance risk, and we need to be very concerned about it and very certain that it's well constituted. I want to say one last thing, and then unfortunately we're done. Number one, sometimes people are using this kind of transaction valuation approach to look at much more complicated interests than simply all of the assets of a clinic. They might be looking at minority interests, they might be looking at partial interest, they might be looking at options. To the extent that that is the case, I think you can assume that it's a very much more difficult thing to appraise, and that your appraisal has much less value in terms of protecting you from compliance risk. Second, I think it's important to fit the appraisal to the story that you're trying to tell. And that's really where we started with all this thing, with my part of the discussion. We don't want to use an appraisal that describes the return on investment from or that assesses the return on investment from a venture and guarantees a positive return on investment as showing fair market value. Okay, we may be able to do a couple of questions. Jim, hit it.
Well, we really haven't received any questions to speak of, but you can certainly email Steve and I if you have questions. Our emails here are on this question screen, or you can call us. We're happy to talk to you on the phone. We would also ask that you complete the survey that will show up on this screen after the webinar ends. And finally, if you would like copies of our presentation today, you can email us or you can contact us at go onto our website, www.fredlaw.com/files/November 2012 webinar.ppt. So with that, we'll say goodbye for another webinar, and we look forward to seeing you or having you participate again next month when we talk about the physician fee schedule. Thank you.